Massive tariffs that could suffocate the global economy, they told us it was just a bluff. That was the exasperated cry echoing across trading floors when rumors first erupted about abrupt halts in trade negotiations between the United States and Canada. Today, we are here to peel back the layers of this sudden roller coaster ride on Wall Street, exploring how, despite dire warnings, certain market indicators are soaring to new heights. What exactly is fueling this unstoppable rally? And could storm clouds still loom on the horizon for global investors? In this in-depth story, we will dig into the astonishing surge of the American stock market and explain why fears over trade relations, the painful memory of past international conflicts, and relentless worries about inflation have not managed to derail a spectacular rise. The burning questions: what stoked the market's appetite for risk instead of fear? How does shifting tariffs affect the average person's wallet? And should we brace ourselves for fresh turbulence if negotiations go sour again? Over the course of our journey, we will examine the twists and turns behind President Donald Trump's on-again, off-again tariff policy, unearth the reality of a volatile Middle East conflict, and unveil the real story on how skyrocketing consumer prices could upend household budgets. By the end, you will understand the unique cocktail of global events that has somehow fueled a market recovery of historic proportions. Ready to dive in? Let's begin. It started with a jolt. Early in spring, analysts watched in disbelief as the Standard & Poor's 500 index, the widely cited gauge for Wall Street's well-being, plummeted nearly 20% from its summit in mid-February to early April. At the time, each new rumor about White House trade expansions, along with mounting anxieties over potential conflict on foreign soil, spurred dramatic sell-offs. Some traders even recalled the not-so-distant memory of deeper, more destructive collapses, fueling a near-panic atmosphere. Then, in a head-spinning reversal, the market soared back on its feet in record time, catapulting us toward a story of resilience that few could have predicted. Sam Stovall, the chief investment strategist at CFRA, described this as a bounce-back in about half the time it would normally take after such a slump. Indeed, just picture the scariest roller coaster drop you can remember, and then imagine that, instead of slowing at the bottom, the ride instantly cranked you upward at breathtaking speed. Despite the swirling concerns about tariffs on steel, autos, microchips, and just about every critical part of the supply chain, the Standard & Poor's 500 has not only returned to form, it has also soared to new record territory. The question torturing many investors is, what is preventing the bottom from falling out? At the heart of the tension lies the abrupt halt in tariff talks with Canada. On a recent Friday morning, news broke that President Donald Trump had decided to put negotiations with Canada on pause, threatening to upend months of creeping progress. Stock market screens flickered red as traders braced for the worst. Then, just after lunch, the fear evaporated as quickly as it had appeared. The Standard & Poor's 500 dipped briefly, but then took another leap upward, sustaining the optimism that has become characteristic of markets in 2025. A year overshadowed by geopolitics, but also marked by a relentless appetite for returns. If the Canada pause was all that threatened the rally, perhaps that alone might be manageable. Yet threads of conflict stretch far beyond North American disagreements. Observers have been fixated on developments in the Middle East, particularly the precarious confrontation between Israel and Iran, an escalation that could disrupt the supply of crude oil and spike energy prices. Amid a patchy ceasefire that has thus far held, the price of oil in the United States has actually dipped back into the mid-$60 per barrel range. This has eased some short-term anxiety, but skeptics warn that, should hostilities flare again, global energy markets could see a swift blow. Meanwhile, signs that the United States might be entering a new era of cooperation with China on certain supply chain components, especially rare earth minerals integral to high-tech industries, have offered a contrasting sense of relief. U.S. Treasury Secretary Scott Bessent underscored a new deal designed to ease the process for American companies to acquire magnets and microchips. This encouraging step might soften some corners of the ongoing trade tussle, but the broader picture is still complicated. Tariffs, potential retaliatory measures, and the looming threat of more severe import taxes remain large shadows over the economy. One key reason the overall stock market has skirted pervasive negativity might be the resilience of consumer demand. Most people are continuing to shop, buy homes, or begin new ventures at surprising rates. Still, inflation chatter is everywhere, Reports show that in May, prices edged up again, nudging the yearly inflation rate a notch higher. Though this particular data release largely matched economists' estimates, the specter of potential acceleration remains. Add President Trump's unpredictable tariff schedule into the equation, and businesses have been left scrambling to figure out how to project costs and set price targets. If these taxes continue to snake upward, eventually they will filter down to everyday goods that could pinch both consumers and corporate profit margins. Historically, surging inflation has been the boogeyman that prompts the Federal Reserve to tighten up interest rates. Yet in this instance, the Fed spent much of 2022 raising rates to fight alarmingly high price increases, only to slash them 3 times in late 2024 amid hopes of supporting a recovery. At the time, inflation soared to 7.2% under one measure, with consumer prices rising as high as 9.1% by another. But in 2025, that once raging fire has cooled somewhat, settling around 2.3% by the Fed's favorite measure, the Personal Consumption Expenditures Index. So the central bank finds itself sitting on the fence, reluctant to cut rates again unless absolutely needed, fearing that any whiff of inflationary rebound could quickly get out of hand. As a result, bond investors are left in a tricky position. The 10-year Treasury yield stands at around 4.27%, while the 2-year yield, more sensitive to monetary policy shifts, holds near 3.74%. Neither of these figures screams panic, but they do reflect underlying uncertainties about what the Fed's next move might be. Traders are betting that perhaps a couple more rate cuts could land before the end of the year, but that is far from guaranteed. Some fear that the slightest sign of resurging price pressures might cause the Fed to abruptly veer off the cut path, which would bring volatility crashing back to the forefront. And what about consumer psyche through it all? After all, it is everyday people, shoppers, workers, families paying mortgages, whose behavior can prop up the economy or tip it into chaos. The White House's reliance on hefty tariffs hits home when you consider that the country imposes a baseline 10% tax on all imported goods. On top of that, specialized levies on Chinese hardware, steel, or autos further complicate supply chains. So, while on the surface calm has returned to the stock market, the hidden costs of these levies are quietly weaving through business forecasts, raising the potential to spark bigger trouble. Companies from large retailers to vehicle manufacturers are sounding the alarm, warning that these taxes will likely eat into their sales and lower profitability in the months ahead. Sometimes, investors shrug off such warnings if overall market sentiment is bullish enough. But repeated hits to revenue could eventually drag down share prices, giving the market a reality check. For now, momentum is riding high, helped in part by surprisingly robust consumer spending. Yet at some point, a bump in the road may come if households start noticing their grocery bills creeping up, their car payments not going as far, or the cost of electronics making them cringe. Pause for a moment and imagine what this means for someone living in a typical suburban neighborhood. They see their paychecks eaten away by subtle but mounting price hikes on everyday essentials. Meanwhile, headlines about trade standstills and tariff escalations swirl around, fueling confusion about what all of it means. One day, interest rates might be cut again, but another day the Fed warns it is standing firm. Are these normal fluctuations or seeds of a bigger financial crisis? This tension can rattle confidence, the intangible but powerful force that underpins market rallies and slumps alike. Though it seems contradictory, it is remarkable how swiftly investors can choose to disregard negative signals if a few shards of good news emerge. That day when President Trump's Canada announcements rattled the morning trading hours, it took only 1 or 2 headlines about interim deals, or hints that officials might come back to the table, and the mood quickly lifted. Suddenly, the Standard & Poor's 500 was sailing new pinnacles. The Dow Jones Industrial Average soared to over 43,800, and the Nasdaq Composite, carrying heavyweights like technology giants, was tapping unprecedented levels above 20,000. Ordinary onlookers might shake their heads, wondering how such dazzling performance can coexist with so many looming stressors. If you are finding this story both riveting and perplexing, give this video a thumbs up. Your support helps us share the real undercurrents of economic drama with more curious minds. We will keep shining a bright light on corporate maneuvers and policy decisions that could affect your bottom line. But let us not move on without addressing a major psychological factor: the sense of relief that sets in once people see the market return to a familiar upward trend. After experiencing a gut-wrenching drop in February and March, many were startled at how quickly the indexes rebounded. That resilience can breed a powerful wave of optimism, even if it is not always well-grounded in broader economic realities. When the Standard & Poor's 500 soared past its old record in February, bulls cheered that there was nowhere to go but up. They heard that the war rumblings in the Middle East had simmered down, that inflation was not skyrocketing anymore. Analysts began talking about unstoppable growth. Still, cracks in that rosy picture can appear without warning. Because tariffs operate like a silent tax on imported goods, many smaller businesses in particular have started seeing their supply costs tick higher. While major corporations typically have the financial muscle to handle a certain level of trade friction, smaller operations might not. Distributors that rely on cheaper imports from abroad can be forced to raise prices, and that can hurt loyal customers. If frustration reaches critical mass, consumer sentiment can shift negative in a hurry, likewise pressuring the stock market to re-examine its ebullience. Add to that the potential for Middle East unpredictability. If the Israel-Iran ceasefire erodes, a new spark in oil prices could undermine consumer spending, since pricey energy often trickles into transport costs, groceries, and more. Investors might suddenly recall their darkest suspicions and rush for the exits. This possibility is precisely why many strategists remain cautious, pointing out that while the market ride has been thrilling, it hinges on an extremely fragile alignment of global events. It only takes one new trigger to knock this balancing act into chaos. Trade watchers fully expect fireworks if the current pause on retaliatory tariffs, set to expire in July, morphs into renewed tensions. If the United States fails to strike fresh deals or extends deadlines, the entire equilibrium might sway, unleashing a new wave of investor anxiety. Remember, we are living in an era where a single White House tweet can shift markets in real time. Indeed, some argue that we are riding a precarious wave, though that wave has delivered handsome profits for many who stayed in the market. But let us dig a bit deeper into inflation itself, for this is a pivotal piece of the puzzle. As of May, official reports show that prices continue their slow creep upward, enough to keep the Federal Reserve watchful, but not enough to provoke immediate panic. That might change if, for instance, tariffs blow up supply costs more dramatically, leading to a bigger spike in consumer goods prices. Then the Fed might have to slam on the brakes or, ironically, ease rates again to soften the blow to growth. The Fed is currently weighing these cross-currents, trying to decide if it should carry out one or two more rate cuts before December. On the one hand, a cut can boost markets further by making credit cheaper. On the other hand, it risks adding fuel to the inflationary tinderbox if consumers keep spending faster than goods can be produced at stable prices. Market professionals remember all too well the 2022 crisis atmosphere, when the inflation rate soared toward that 9.1% threshold. Back then, everyday Americans saw the costs of groceries, clothes, and gas leap frighteningly. The Federal Reserve felt cornered, forced to ratchet up interest rates multiple times to parry what looked like an unrelenting climb in prices. A wave of relief followed the pivot in 2024, when the Fed slashed rates thrice, eventually cooling the inflation threat. That sense of relief blossomed into the confidence behind today's record market levels. But the question lurks, are we simply ignoring the next potential surge in prices? Of course, not everyone interprets the situation the same way. Some optimists argue that the United States consumer is stronger than the numbers suggest. They point to robust job gains, decent wage growth, and the resilience that people demonstrated throughout the pandemic era and beyond. Others worry that all this positivity could vanish if the cost of living jumps by even 1 or 2 more percentage points, especially if wages fail to keep pace. For now, the story is about balance, but that balance is getting more precarious by the day. A prime example of how quickly fortunes can change. Imagine a mid-sized auto parts manufacturer that depends on imports of steel from overseas. That steel is now subject to at least 10% in baseline tariffs, plus more if the White House imposes special duties on countries it deems unfair traders. The manufacturer can try to absorb the costs, but after a while, it has no choice but to pass them on to the consumer. Ultimately, that might mean higher car prices at the dealership, or fewer new features on vehicles to keep costs down. Consumers might still buy, but at some point they will begin to balk, or perhaps shift to used cars, hurting new car sales. Multiply that scenario across countless industries, and you see how quickly the cumulative effect can weigh on economic growth. Yet, each time a fresh chance for alarm surfaces, the market rides it out and closes higher, as if propelled by an unstoppable force. There was the day Nike soared 15.2%, defying any gloom by issuing new product lines and commanding brand loyalty, even as the company admitted tariffs were biting into certain profits. We saw technology shares shrug off supply chain headaches, presumably anticipating that the new trade agreement with China over rare earth minerals would keep microchip production humming. And let us not forget the unstoppable feel of the energy sector, which has somehow weathered the storms in the Middle East so far. Speaking of storms, one cannot ignore that larger cyclical patterns could always come back to challenge this rally. Has the market soared too far, too fast? Sam Stovall might be correct in suggesting that previous downturns have historically taken longer to rally back from major losses. This surge in roughly half the typical time is, to some, suspiciously reminiscent of a melt-up phenomenon, a final euphoric run before a steeper correction. But if you told that warning to the bullish traders who pocketed tidy gains in recent weeks, they might just laugh and say that momentum outweighs fundamentals in 2025. Let us take a moment to step back from the raw data and reflect on the daily lives of people who are riding this wave, for better or worse. Many families who have retirement accounts tied to indexes like the Standard & Poor's 500 or the Dow Jones Industrial Average are feeling pleasantly surprised as they see their nest eggs grow. They are watching, somewhat perplexed, as the news cycles keep mentioning trade tension or Middle East troubles. Yet the statements on their portfolios are climbing. Some wonder if they should lock in gains now, while others fear missing out on the next leg higher. Fear of missing out has been a powerful force driving markets upward, overshadowing anxieties about potential blowback. But is it all sunshine? For families living on tight budgets, the question of inflation is urgent. Food is slightly more expensive, electronics are no cheaper, and the possibility of price hikes on everyday items remains unsettling. If you are making just enough to cover monthly bills, the concept of a record-breaking stock market might not mean much if your grocery costs keep climbing. Moreover, if the Fed ends up raising rates again to tame an unexpected price surge, then loans and credit lines would become costlier. In that scenario, those household budgets constrained by credit card debt could buckle under the strain. Riding along this precarious seesaw, are investors ignoring the flashing signs? Or are we indeed in a period of unstoppable growth, fueled by robust consumer confidence and strategic deals with foreign trade partners? The answers could emerge in the next few months, as the White House either extends or drops new rounds of tariffs. It is also possible that the Middle East tension remains at a simmer, never quite boiling over enough to shock the oil markets again. If so, that could pave a smoother path for the stock market to levitate further. We are only halfway through the year, and already the Standard & Poor's 500 sits above 6,173.07. The Dow well past 43,819.27, and the Nasdaq close to 20,273.46. All these figures represent quite an achievement, garnering headlines that read more like science fiction for those who recall when these benchmarks were just a fraction of their present size. In many ways, it is a testament to a robust economy that overcame past disruptions. But a fair question is, how many collisions can the ship weather before taking on water? If you have enjoyed diving into this intricate saga of trade policies, foreign conflicts, and mysterious market surges, consider subscribing to our channel so you can stay informed on more financial dramas. We promise to keep unveiling the truths and tensions that shape our interconnected global economy. In the meantime, the market roars ahead, and we close with a reminder that none of these issues are resolved for good. The threat of more rigorous tariffs still hangs like a sword over the heads of importers. The possibility of renewed hostilities in the Middle East forever lurks on the edges of the nightly news. The Federal Reserve sits in watchful caution, aware that cutting rates too soon could inflame inflation, but waiting too long could hamper growth if economic shocks intensify. And overshadowing everything is the question of how long consumers can keep sustaining strong spending in the face of creeping prices and shaky economic signals. This is the breathtaking high-wire act that defines markets in 2025. Will the triumphant run continue, fueling further records on the Standard & Poor's 500, the Dow, and the Nasdaq? Or are we courting a dramatic collapse that will catch everyone off guard? Traders, policymakers, and everyday folks alike are hanging on the next announcement, the next data release, and the next global headline. So, as we end our story, remember, while records are made to be broken, the margin between exuberance and upheaval can be razor thin. One critical policy decision, one confrontation abroad, or one surprise in the inflation data could change everything overnight. For now, the bulls are celebrating an all-time high that seemed unimaginable only a few months ago. But the ultimate fate of this remarkable rally remains just beyond the horizon, waiting for the next twist in a dramatic economic tale that is far from finished.